This is Richard Campo from Rose Capital Partners. I wanted to put this video together to give you some key considerations when you're thinking about remortgaging from a mortgage perspective. When you come around to remortgage time, there's probably three things that you approach this from. First will be your mortgage deal's coming to an end and you just want a straight swap because you're really happy with everything else and you just want a cheap deal. Well, that's great. We'll talk about some of the product options a bit later in the video. Secondly, it may be an opportunity to restructure the loan. Maybe there's been some changes to your situation, or maybe you just want to have a bit of a review of the loan. Now that second one is really key because even if you are just rolling the loan forward, because rates have come down quite a lot over the last few years, it could be a great opportunity to pay the loan off faster, maybe look at some different product options you weren't thinking of, or maybe you're looking at moving as well. So it is worth reviewing the loan rather than just sort of rolling things and just taking a straightforward view. The third one is really the key one. If you want to then maybe borrow more money, it may be a case you want to do some home improvements, maybe you've got some debts you want to tidy up, recoup some school fees, buy a car, whatever really. That's absolutely fine. The general dividing line with the bank is that you can borrow for any legal purpose, so just bear that in mind. Also, another thing to think about, particularly around sort of debt consolidation, that type of thing, is does it make sense? Because what you might find if you've got, for example, an interest-free credit card elsewhere, it wouldn't necessarily make sense to roll that into a loan. So all of those things are fine, but you do need to think about what you're doing and why and what knock-on impact that has on the price. So that's quite a complex thing I won't have time to get into today, but just think about those real key aspects. But if you are looking at borrowing more, then again, there's always sort of two key considerations you probably want to think about is how much you're going to borrow and how much it's going to cost. So in terms of how much you can borrow, there's quite a short answer, which is about 4.5 times your income. Now, that's sort of very simple. Some banks do go some higher, some lower, but that's sort of the market average. The highest you can get to is around about 5.5 times your income if you want to be at the upper level. Now, just picking a really simple example for the sake of maths is that let's say you earn £100,000 a year. You think, well, I can borrow about 450. That's nice and simple. But the way that banks assess income doesn't mean it always works out like that. So for example, if you do earn £100,000, it might be that your basic salary is say £50,000, but your bonus is £50,000 also. Now, what some banks do will take half of that bonus income and some don't take any at all. But the majority of banks generally take about half of what they call variable income, so bonuses, commission, that type of thing. So on that same assessment, they won't actually say you earn 100, they'll actually assess you at 75,000, which means, if my maths is correct, 4.5 times income, that takes you to a loan of around about 337,500 rather than the 450 you're expecting. Now again, big risk warning is that not all banks take that approach. Some are more flexible, some are tighter, but that just gives you a good sort of finger in the air as to how things work. Now, if you're self-employed, things are a lot more complex still. So what banks tend to do is look at one of the following things. They'll look at your profit, your salary, your dividends, or something called your profit on ordinary activity before tax. Easy for me to say. You might even be a partner of an LLP as well. So there's lots of different ways you can be structured if you are self-employed. But again, the same principle holds true. Because once we've sort of got down to sort of what's the best assessment of your income, we can apply that 4.5 times multiple. Again, there are some upsides as well for being self-employed. So let's say, for example, you run a limited company. What some banks will do is effectively gross up your dividends, which means you might be able to borrow more than on the standard PAY format as well. So it's not all bad news when you're self-employed. So that's really sort of how much you can borrow. In terms of how much it can cost, so that's really driven by the structure of the loan. And again, that falls into two broad brackets. The first part is what we call the repayment method. So do you want a repayment loan, an interest-only loan, or a combination of the two? With repayment, it's nice and straightforward. The amount you borrow day one is paid off each month, and with the interest and the capital until the end of the term, it's paid off in total. With interest only, you pay just the interest that sits on top of the account, and you look to pay it off at the end by way of investments, bonuses, simply selling the property, something in that sort of way. And again, you could do a combination of the two. That has the biggest driver on monthly costs, so that's something to bear in mind. Secondly, is then what sort of product you'd like. Again, this falls into two broad camps as well. So you have fixed rates, which does what it says on the tin. So typically for 2, 3, 5, 10 years, you fix your monthly payment and nothing changes. You could choose to have a variable rate loan, which is sometimes cheaper, but not too much at the moment. But variable rates tend to give you a bit more flexibility. They're often penalty free. So that may be advantageous if you're looking at moving, had changes on the horizon, something like that. So again, it's worth sort of thinking about what product suits you best. So that's broadly how the cost is determined on a mortgage. But rather than sort of play around with these things to say, well, that's how much it costs, we actually turn it around and say, well, how much can you afford? How much do you want to spend? Once we start at that point, then we'll look at those factors and structure the loan to suit you more correctly based on what you're willing to spend and what your risk profile is. So hopefully that's been a sort of useful introduction as to what we can think about when looking to remortgage. So quite a complex area, but whatever the mortgage goal you're looking to achieve, we'd love to help. So please get in contact and we can talk about these things in more detail with you. Thanks a lot.